Ladies and gentlemen, good day and welcome to Hindustan Unilever Limited conference call for the results for December quarter 2022. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. A. Ravi Shankar, Group Controller and Head of Investor Relations. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone, and welcome to the conference call of Hindustan Unilever Limited. Best wishes to all of you and your families for a wonderful 2023. We'll be covering this evening the results for the quarter ended 31st December 2022. On the call with me is Sanjeev Mehta, our CEO and Managing Director, and Ritesh Tiwari, our CFO. We'll start the presentation with Sanjeev sharing an overview of our performance in the quarter and the operating environment. Ritesh will then cover our financial results, outlook, and also cover the details of our new royalty arrangement. Before we get started with the presentation, I would like to draw your attention to the safe harbor statement included in the presentation for good order's sake. With that, over to you, Sanjeev.
Hi, good evening, everyone, and thank you for joining the call. My first engagement with you this year, and I take this opportunity to wish all of you a fabulous new year with good health, success, and tons of happiness. Now, let me begin with a summary of our performance for the quarter, and then I'll talk about the external environment and our strategy. We have the momentum. We delivered yet another quarter of solid all-round performance. Our top line grew 16% with an underlying volume growth of 5%. EBITDA margin remained healthy at 23.6%, sequentially improving by 30 bips over the last quarter, led by a step-up in gross margins. Our earnings per share grew 12%. We continue to significantly outperform the market with over 35% of our business winning both value and volume market shares. Sustainability remains core to our business, and I'm very happy to report that we have received industry-leading ratings when it comes to ESG. To sum up, in the last 9 months of this fiscal, we have added more than 6,000 crores to our top line and reported a turnover in excess of 43,000 crores. Our net profit grew 14% to more than 7,400 crores. Our consistent, strong all-round performance is a testament to our strategic clarity, strength of our brands, our capabilities, our execution prowess, and agility to run the business. And most importantly, the determination and passion of our talented, purpose-driven people. Now, let me spend some time on the external environment, the inflationary situation, and the market growth. This year, the FMCG industry has witnessed unprecedented inflation across a wide basket of commodities led by supply-side issues. Lately, we have seen a few key commodities soften, notably palm oil. With this, the year-on-year inflation is moderating gradually from its peak. The consumer price inflation has also softened in recent months. Having said that, commodities remain at an elevated level when compared to long-term averages. This is evident when you look at inflation from a 2-year lens. Commodities such as crude oil, soda ash, food ingredients are seeing close to 100% inflation when compared to the December quarter of 2020. The other, of course, the source of inflation has been the currency. US dollar is appreciated by more than 10% versus rupee this year. Overall, if commodities remain where they are, we expect the inflationary pressure to moderate gradually, and this augurs well for our industry. Now, talking about FMCG market growth with reference to the categories we operate in. In December quarter, the market grew about 8% year-on-year, which was higher than the growth in September quarter. Benefit of higher festive sales was seen in September and October months, which grew at double digits. Growth continued to be price-led and volumes declined, although the decline in December quarter was lower than previous quarter. This December happened to be India's warmest in more than a century. Delayed onset and less severe winter adversely impacted the performance of categories such as hand and body care, facial moisturizers, and similar categories. Now, talking about FMCG market growth from urban and rural lens, urban markets have continued to lead the growth. Rural has shown some signs of improvement with December quarter growth higher than growth in September quarter and the last 12 months. If I were to summarize the last 3 slides, we can say that there is a gradual improvement in the FMCG operating environment. Commodity inflation seems to have peaked and is moderating from its unprecedented level. With lower inflation, strong winter crop sowing, and signs of pickup in farm incomes, it is likely that rural slowdown is bottoming out. The next few months will give us further certainty on this aspect. In this context, our strategy, of course, remains unchanged. One, we will continue to operate the business with agility and remain focused on growing our consumer franchise while protecting our business model. Secondly, we will continue single-mindedly on a journey to create a purpose-led future-fit HUL and deliver on a 4G growth. And by now, I'm sure every one of you is conversant with this 4G growth mantra of consistent, competitive, profitable, and responsible. Now, we have always believed in doing business responsibly. In fact, we believe it is the only way of doing business. A shining example of this is Prabhat, our sustainable community development initiative, which we started in 2013. In the last 9 years, Prabhat has made a positive difference to nearly 9 million people in the communities around our factory and depot locations, be it through economic empowerment, environmental sustainability, or supporting health and nutrition. The great work done under Prabhat has also been recognized by the World Economic Forum. It also won the FICCI CSR Award for Skill Development. October 15th is observed as Global Hand Washing Day with the aim of increasing awareness of hand washing with soap, which is an effective way to prevent diseases and save lives, as we all saw during the pandemic. Our purpose-driven brand Lifebuoy has been championing this cause for several decades, building on its impact created so far and amplifying it further. Lifebuoy has partnered with children as young change makers to take on the mantle of H for hand washing Chief Education Officers, the CEOs. Over the years, Lifebuoy has reached 500 million people in India, educating them about healthier habits. Last month, we announced a foray into the fast-growing health and well-being category. This is squarely in line with a strategy to develop a portfolio in fast-growing demand spaces. One of the mega consumer trends that we are witnessing in the Indian consumer market is the increasing focus of consumers on the health in a very holistic way. From health as absence of disease, we are seeing a rapid shift toward health as a lifestyle pursuit. With the strategic investments in Oziva and well-being nutrition, we welcome 2 young science-backed new age brands into the HUL family. We have completed both the deals and are absolutely delighted to partner with the 2 businesses. The 2 companies will continue to be run by the respective teams led by their wonderful founders. HUL will provide them the necessary support needed to scale up their businesses, be it a strong understanding of consumers, our R&D capabilities, our regulatory expertise, our execution excellence, and the digital capabilities. We will also leverage Unilever's experience of running a billion-euro health and well-being business. With this, let me now hand over to Ritesh to talk about the performance in this quarter and outlook in detail, and then go on the subject of royalty. Thank you.
Thank you, Sanjeev, and good evening, everyone. My best wishes to you and your family for a great 2023. I will now walk you through our in-quarter performance and our outlook. Starting with overall results, this was yet another quarter of strong all-round performance. Our turnover for December quarter grew 16% with an underlying volume growth of 5%. Both value and volume growth were significantly ahead of the market. EBITDA margin was at a healthy 23.6%, sequentially up 30 bps, led by gross margin improvement. On a year-on-year basis, EBITDA margin declined 180 bps, impacted by 480 bps increase in cost of goods sold, partly offset by savings and leverage across other lines of the P&L. Net profit at rupees 2,505 crores grew 12%. Profit after tax before exceptional items grew 13%. Let me click down further to elaborate how we are dynamically managing our business. We are seeing sequentially inflation softening in few key commodities. As we had anticipated and called out earlier, our DQ22 net material inflation or NMI at 18% was sequentially lower than September quarter, albeit very high on a year-on-year basis. This helped partly bridge the price versus cost gap, leading to improvement in gross margin from 45% in September quarter to nearly 47% in December quarter. With softening in commodity, media intensity for categories in which we operate was higher in DQ22 versus SQ22. We continue to maintain our share of voice ahead of share of market and invest competitively behind our brands, leading to 80 BPS quarter-on-quarter step up in A&P investments. Moving on to performance across our three segments. Home care delivered yet another stellar performance, growing at 32% with double-digit volume growth. Beauty and personal care grew 10% despite the impact of delayed winter on skincare portfolio. Foods and refreshment delivered 7% growth. Margins in all three segments remained healthy, with home care at 19%, BPC at 25%, and FNR at 18%. We will click down to talk about performance within each of the divisions in subsequent slides. Starting with some of our key innovations for this quarter, TRESemmé launched a new salon-inspired keratin range of shampoo, conditioner, and it is enriched with Bondplex technology, our latest innovation that goes deep inside to repair broken hair bonds and make hair up to 20 times stronger. With Sensex, we launched our first ever scrub soap range. Sensex soaps are made with 100% natural ingredients like coconut water, aloe vera, walnut scrub that scrubs out dead skin cells and gives naturally glowing skin. Lakmé launched new range of serums spanning benefit spaces of brightening with niacinamide, hydration with hyaluronic acid, and anti-aging with pro-retinol. Lifebuoy launched a new superior soap with neem and aloe vera. Red Label launched a new premium tea, especially designed for pregnant and lactating women. It has 80% less caffeine content, and its Ayurvedic ingredients not only ensure a great taste, but also known to nourish and energize the body. Brew's new decoction coffee is the perfect way to enjoy delicious and strong filter coffee. Taking inspiration from the latest cuisine trends and consumer insights, Knorr has launched Korean meal pots and added new flavors in soup, a perfect solution for hopeless chefs like me. We have now quite a few interesting activations this quarter. I'm sure you heard the buzz around Vim's latest campaign. Vim is deeply committed to championing the cause of everyone taking ownership for their own home chores. His Vim Black campaign, which as a satire launched Vim Black, specially designed for men, triggered a lot of social media conversation and got a very strong consumer response. Other key campaigns include Sensex Pujo activation and new ad films by Horlicks and Surf Excel. Moving on to a performance in home care, this is another stellar quarter for home care with 32% growth led by solid performance across the portfolio. Despite high pricing, home care continues to grow volumes in double digit, reflecting the strength of our brands. Fabric wash grew in high double digit with strong performance across brands and formats. Business continues to gain handsome market share, both value and volume. Household care accelerated further and grew in high double digits with strong performance in both dishwash and surface cleaners. Volumes grew in high teens. With significant input cost inflation, we have taken calibrated pricing actions in both fabric wash and household care. Talking about beauty and personal care, the business grew 10% led by skin cleansing, delivering broad-based double-digit growth. Volumes of skin cleansing grew mid-single digit. With softening in palm oil prices, price reduction were taken in soaps portfolio. Hair care delivered high single-digit growth. Our innovations and future formats such as masks and serums continue to gain consumer relevance. Delayed onset and lower intensity of winter impacted performance of winter portfolio in skincare. Non-winter portfolio performed well, delivering double-digit growth. We continue to expand our portfolio in emerging and on-trend demand spaces through focused innovations and market development actions. Oral care had a steady quarter led by close-up. Let me now turn to foods and refreshment. F&R grew 7% led by strong performance in foods, coffee and ice cream. Tea continued its value and volume market leadership and grew volumes in mid-single digit. Overall value growth was soft, reflecting the impact of price cuts. Coffee sustained its strong growth momentum and grew in double digit. Health food drinks grew mid-single digit with strong performance in Boost and Plus range. We continue to gain market share and penetration led by effective market development actions. HFD market remains subdued due to impact of inflation. Foods delivered volume-led high teens growth with strong performance in ketchup, jams, and food solutions business. Our food solutions business that provides products for chefs and restaurants continues to scale up and is now almost twice the pre-COVID levels. Ice cream had another strong quarter with double-digit growth led by festive activations and delicious innovations. Summarizing our performance for this quarter, we had a strong top line and bottom line delivery. I've already covered most of the lines, but let me pick up other income which saw an increase due to higher treasury yield and dividend from subsidiaries. Exceptional items were higher due to increase in supply chain restructuring cost. Effective tax rate for the quarter was 26%. Considering the impact of tax PPA that we received in the first half of this fiscal, we expect our full year ETR to be around 24%. Let me quickly take you through our year-to-date numbers for this fiscal. Our performance was strong both on top line and bottom line. We added 6,000 crores to our top line, growing at 17% and taking our 9-month turnover to over rupees 43,500 crores. Despite unprecedented levels of inflation, we grew our EBITDA by 10% to more than rupees 10,000 crores. Net profit at 7,410 crore grew 14%. Now moving on to our outlook. We remain cautiously optimistic in near term. As we had seen earlier in the presentation, we have seen softening in a few key commodities, notably palm oil. If commodities were to remain where they are, and we believe that the worst of inflation is likely behind us, this augurs well for FMCG industry and should aid in gradual recovery in consumer demand. Having said that, we must be mindful that year-on-year inflation is still high and we expect growth to continue to be price-led. In this scenario, we will continue to manage our business dynamically with focus on ensuring right price-value equation for a consumer and building back gross margin. We will continue investing competitively in our brands and market development actions, leading to a further step up in our A&P investments. As Sanjeev mentioned, our strategy is unchanged and we remain focused on delivering 4G growth that is consistent, competitive, profitable, and responsible. Now you would have seen our announcement today about new royalty and central service arrangement with Unilever. In next few charts, I will cover the context and details of the new arrangement that has been approved by our board of directors today. Our current trademark and technology license and central service agreement with Unilever was signed in January 2013 for a period of 10 years. The effective payout for this arrangement was about 2.65% of turnover for the last fiscal. To put simply, this agreement grants us 3 key things. Number 1, the right to use Unilever owned brands. Secondly, it gives us access to Unilever's technical know-how, world-class R&D and innovation capabilities. Third, we leverage Unilever's expertise and services across various functions, including procurement, marketing, quality, manufacturing excellence, talent management, amongst others. I will give more color on each of these in subsequent charts, but important to call out that these capabilities have greatly equipped us to meet many emerging consumer needs and trends with agility and thus win in the marketplace. If you were to look back during the contract tenure, we almost doubled our turnover to more than 50,000 crore and improved our EBITDA margin by about 1,000 BPS. There is 100 BPS improvement on average every year. Let me now click down, as I mentioned earlier, on 3 elements I spoke about. Unilever, as you know, is one of the largest global consumer goods company with over 52 billion turnover spread across its 5 business units, namely beauty and well-being, personal care, home care, nutrition, and ice cream. It's a truly global company with presence in over 190 countries and a strong understanding of emerging markets. About 60% of Unilever's turnover comes from emerging markets. Unilever is known for its great brands and purpose-driven business model. It has a wide portfolio of over 400 brands spread across several FMCG categories. Many of these are iconic world-renowned names. 12 Unilever brands feature in Kantar's top 50 global brand list. It also has a very strong portfolio of on-trend brands in new and emerging demand spaces. Talking about Unilever's R&D prowess, Unilever has deep science and technology expertise. It has a team of over 5,000 R&D professionals with many world-leading experts in their field, from things like material chemistry, microbiome, alternative models to animal testing. Globally, Unilever has over 20,000 patents and patent applications. It has a very large network of innovation partners, from big suppliers to innovative startups to some of the biggest technology companies in the world. With 8 global technology and innovation hubs that sit in key markets across US, Europe, India, and China, Unilever R&D has global scale and local knowledge. Annually, Unilever spends over $850 million in R&D doing cutting-edge work, which will not only serve the consumer today, but also in future. Some of the examples include the work being done on renewable ingredients, where Unilever is working on carbon rainbow, biosurfactants for cleaning products, which are 100% renewable and biodegradable. Next generation biology is another key field where work is being done on microbiome and immunity, which is relevant for many of the categories, including hair, skin care, skin cleansing, and oral care. Unilever has a state-of-art food innovation center in Netherlands, where they are doing a lot of work on sustainable food systems, such as non-dairy plant-based protein. Many of these innovation technologies have already been deployed in India, and others we will keep bringing at appropriate time. It is important to note that R&D and technology not only helps us land faster, better innovation, but also in driving product cost optimizations. The third key arrangement for us as part of this overall scheme is a wide array of centralized services and functional expertise. This is really about leveraging Unilever's global scale and expertise across various functions, be it supply chain, procurement, marketing, or talent management. On the chart, you will see some of the examples of centralized services and support that we receive from Unilever. Access to this gives us significant competitive edge. Let me bring this alive with a couple of examples. If you look at our overhead cost, employee cost and other expenses put together, we are leading industry benchmark. And this is after having taken in the expense line overall the royalty central services cost, which sits in this bucket in the last 1 decade. Our inventory levels are best in class. Access to Unilever's world-class manufacturing techniques, efficiency improvement programs, deeper planning and forecasting capabilities gives us the agility and ability to run our operations very efficiently. Another good example is Unilever's procurement capabilities. Unilever globally spends over euro 20 billion in raw and packing material. Its huge scale and global presence gives us a significant competitive advantage in sourcing of input materials. Many of you would recollect from our Capital Markets Day about net revenue management and how it helped us navigating business during challenging environment. This entire science around NRM is something that we got from Unilever. Let me pick up an example on digital marketing. As you're aware, digital marketing has been gaining a lot of relevance in recent times. Unilever globally has developed centralized toolkits and digital assets which can be used by Unilever Group companies, including HUL, to deploy its digital marketing strategy in their respective geographies. We have been able to leverage on the efforts of external agencies and knowledge database on marketing to deliver impactful digital marketing campaigns. So overall, we greatly benefit from Unilever's functional expertise and centralized services. The current contract, which was for a term of 10 years, will expire on 31st January 2023. On the imminent expiry of this contract, Unilever requested for a review of the same. We have been receiving a steady stream of benefits, as I mentioned, from Unilever in terms of faster innovation, superior products and technology, greater expertise, and enhanced services. This helps us to continue to meet emerging consumer needs with agility and create value for all stakeholders. With India being one of its top 3 priority markets, Unilever remains committed to support HUL with dialed-up access to faster innovation, investment, technology, and capabilities. The new contract terms are subject to a detailed evaluation and due diligence led by our senior management and guided by our audit committee and board. A reputed Big Four firm was engaged to conduct independent external benchmarking of comparable transactions. Taking the detailed due diligence and external benchmarking into consideration, HUL board has today approved the new royalty and central service arrangement effective 1st February 2023 for a tenure of 5 years. The new arrangement envisages a staggered increase of 80 BPS over a period of 3 years from circa 2.65% to circa 3.45% of turnover, which will result in an effective increase cost 45 BPS from February to December 23, a further 25 BPS increase in effective cost from January to December 24, and a circa 10 BPS further increase in effective cost from January 25. So a total of 80 BPS over 3 years. New arrangement is subject to appropriate regulatory approvals. This new arrangement is one of the necessary investment that positions HUL well to continue delivering consistent, competitive, profitable, and responsible growth. Before we move to our Q&A session, let me summarize what we covered till now. We delivered yet another quarter of strong all-round performance with 16% top-line growth and 5% underlying volume growth. With price versus cost gap narrowing, we improved gross margin sequentially by 170 BPS and invested 160 crore more sequentially in A&P. Our EBITDA margin remains at a very healthy level and improved 30 BPS sequentially. Looking ahead, we remain cautiously optimistic in the near term. We believe peak inflation is behind us and this should aid in gradual improvement of consumer demand. Growth will continue to be price-led, albeit the level of price growth will be lower from here on. We will continue to manage our business dynamically with a focus on ensuring the right price-value equation for our consumers, building back gross margins and stepping up A&P investments. Lastly, HUL board has approved the new royalty and central service arrangement with Unilever effective 1st February 2023. This envisages a 80 BPS increase staggered over next 3 years. This is a necessary investment which positions us well to meet emerging consumer needs with agility and continue delivering 4G growth. With this, we complete our prepared remarks and let me now hand over to Ravi to begin Q&A session.
Thanks, Ritesh. With this, we'll now move on to the Q&A session. So that we are able to take questions from all participants, I request you to kindly restrict the number of questions to a maximum of 2 at a time. In case you have further questions, you're free to join the queue again. In addition to the audio, as always, our participants have an option to post the questions through the web. We'll take those questions just before we end. With that, I'd like to hand the call back to Aman to manage the Q&A session for us.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks. Congratulations, Sanjeev, on the results. My first question is on the royalty aspect. So 3 bits to that. One is earlier contract was for 10 years. This is for 5 years because then the risk for increase, say 5 years down the line clearly seems to be there. So what's the thought process behind 5 years and not 10 years? Second is why is the increase front-ended? So 45 bits in first year and then 25 and then 10. So what's the thought process? And third is what are the approvals needed here?
Abneesh, thanks for your question. So let me just pick up all 3 elements that you mentioned. So first of all, the contract duration. You're right, the earlier contract was for a period of 10 years. And we know the world is very, very volatile and we are living in times which are very different. In these times, it's a good corporate governance to lock in a contract for 5 years. And as situations will change, will improve in different directions and the context will change, we will then have a chance to revisit the terms that we are agreeing to. And which is why this time the agreement has been for a period of 5 years. And then your point on overall increase, let me just spend a few minutes in talking about it. First of all, there are 2 components out here. there is a royalty, and royalty has two sub-components. There's a royalty for trademark, for usage of brands of Unilever, and second for usage of technology that we get from Unilever. That's one component of the arrangement. The second large component of the arrangement is central services. So we get many services from Unilever, and I gave multiple examples as part of my presentation, be it procurement, be it digital marketing, be it learning, and be it other capabilities that we get from Unilever. And that's the second large component of the arrangement. The 3.45% destination as part of the 5-year term arrangement that we spoke about is basically 1.95% for the bucket of the two royalty put together and 1.5% for central services. Now, this total rate of 3.45%, as we called out, will increase by 80 BPS. And while approving this 80 BPS and considering the proposal, board conducted a very detailed due diligence process. Board appointed, as I mentioned, a Big Four firm to also do an independent assessment of the rate of increase which was getting considered as part of the proposal. And we received those independent benchmarks, and the new rates that we have are very competitive. That was one assurance the board took as part of the process. Second, of course, is the amount of benefits that we get from Unilever. Because behind this contract also is stream of benefits, be it brands that we get from Unilever, or be it technology for driving across our portfolio that we get from Unilever, or for that matter, multiple services that we get from Unilever. HUL remains a top 3 priority market for Unilever, so these benefits will continue to come to our business for times to come as part of the contract. Look at the last decade. In the last decade, as part of the contract, with all the benefits that we have received, we run a very successful business. The business has doubled in terms of turnover and has also improved healthy margins as well by 1,000 BPS. That's one element. Now, the second element of the whole conversation out here is the context in which we're agreeing, and which is why there's a very thoughtful job of ensuring that the increase is spread out over a period of 3 years. And that's where the judgment of board has come in terms of making the contract over 3 years, and you heard the 3 numbers that we spoke about. So this is in terms of the overall context in which we have done the arrangement, and what we have now is approval from the board of directors. Going forward, we know the requirement under SEBI's LODR, or for that matter Companies Act, that any material transaction will require appropriate amount of approvals, regulatory approvals. It will be the case in this case as well. And we will take those approvals as required. We remain confident. At the end of the day, we know that this arrangement will bring superior value to all our shareholders, and hence we should be able to create a very clear business case that how this arrangement will continue to benefit our business going forward. And that, in my mind, will be the foundation basis which we will then conduct the balance approvals going ahead.
So thanks. My last question is on 2 of your categories. So when I see your HFT, the commentary seems to be improving, and you have said that strong performance in Boost. So wanted to understand, you have taken so much of marketing initiative and the 2 rupee sachet, etc. in Horlicks also, but you're pointing towards Boost. So wanted to understand why Boost is going faster. So is it linked to the overall rural slowdown? So the lower end, smaller packs in Horlicks is linked to the rural slowdown. So it will recover when the rural recovery happens. Is that the reason? And second category I want to ask is, in fabric wash, kind of highly penetrated, the double-digit volume growth, the market share gains are coming from the number 2 player or essentially from the regional, because it's not a high growth category to start with, but double-digit growth is a good achievement.
Yeah. No, thanks, Amish. So let me just pick up both of your questions, and let me start with HFD. HFD, we have called out very clearly the jobs that we have to do in this space. First, our job was to drive cost synergies, and we have mentioned in last few quarters consistently how we are running ahead of the business case in terms of driving cost synergy. And the second big job for us is to drive revenue synergy. And this is where we had articulated that to drive revenue synergy, the big job to be done is to drive market development, because we have to increase the relevance of this category and drive penetration. Our commentary has been consistent and strong that for last quarters, as we've spoken about, that this market development efforts have started to yield results. And you've seen that last few quarter commentary we spoke about how we are improving market share, how we are able to improve penetration of the category. And ultimately, that's the objective when you spend resources behind driving market development. And of course, we have a portfolio out here be it the plus range, and which is what we mentioned, that we do want to dial up the plus range, which gives higher order benefits and science-based benefits to a consumer. Equally, Boost, we took Boost from certain set of geographies, and we took Boost nationally and activated the brand. And it's a very different consumer profile that uses Boost, or for that matter, that consumes Horlicks. And you're right, Horlicks has different price points and different pack sizes, which are sold and experimented by different consumers. So if I look at overall business performance for Horlicks, the objective of achieving penetration growth, the objective of achieving market share gain, we have delivered on that as well. Overall, the inflation impact, as we have called out on HFD, has been meaningful. And it is not the case only with Horlicks as a product. To make a cup of Horlicks, we require Horlicks and a cup of milk. And milk prices, as we called out and Sanjeev covered as well, the kind of inflation that we've seen in milk price and hence the overall cup of Horlicks, that inflation impact has impacted discretionary consumption. But at the end of the day, the job is very clearly cut out for us, which is to keep driving category relevance, and we are seeing better results coming from that. Now, coming to your question on fabric wash. Fabric wash is a category we called out that over the last 1 decade, the kind of work we have done to change the way we sell the fabric wash portfolio. Our premium products, be it liquids, be it premium powders, have grown pretty well, and the total portion of our business in a portfolio now is over-indexed to liquids and premium part of the portfolio compared to mass part of the portfolio. That shift over a period of time has given us a benefit. I mean, when you talked about the growth, price, and UVG, remember, Amish, in our case, UVG growth has 2 components. It has a component of volume, tonnage growth. It also has a component of mix. So when you sell higher products which are premium, the benefit of that overall comes in the bucket of UVG. And you heard us talking about strong UVG growth also in the case of laundry. And that's the business model that we have at play out here.
I'll just amplify, Abneesh, on the HFD and the laundry story. You know, in many ways, the work that we are doing on HFD is the work that we did in laundry 7-10 years back. And that is the benefit that we are now reaping. We invested in very clear strategy first. Second is we had multiple formats and brands and sub-brands to play with. And then we invested significantly in market development to help us get into higher order benefit space as well as premiumize the portfolio. Now, in laundry, you had a question, whom are we gaining with? Let me tell you, the kind of growth we have got is nearly in the vicinity of 30%. Surf Excel, Wheel and Rin all are growing in that vicinity. And same goes with Comfort, which is also in the 20s growth. So when you play it well, and this is a similar thing we are trying to imitate, but in a different manner with HFD as well, so that you start getting the benefit of this. And the early signs are that our penetration and our shares have started moving majestically over the last 1 year in HFD.
Sure, Sanjeev, thanks. That's useful. Just one last follow-up on the health food. So you now have 2 brands here. So Oziva also has obviously great products, decent brand. Some products there can be an overlap now or later also. If you could tell us in terms of brand architecture and focus, how do these 2 brands play in the slightly more premium health category? I'm not talking about the HFD. I'm talking about some of the other premium products where both can play. How the differentiation would be?
Now, health and wellness is relatively a nascent category in India. Now, here we are getting into demand spaces such as sleep, beauty from within, gut health, and these are where the acquisitions that we have done and health and wellness is going to focus on. Now, in many ways, this will be complementary to the work that is happening on the HFD business, because that is also working on nourishing 1 billion lives. Now, that is looking at helping people who are undernourished or malnourished, or people who suffer from vitamins, mineral deficiency and all, to plug that gap. Whereas here, it will be very specific in areas that I talked about, like gut health, sleep, and beauty from within. Now, both these brands are still at a very nascent stage. And at the end of the day, the way we play the portfolio, that it may be in a similar demand space, but it could be a different proposition and different pricing point. That's how we will try to differentiate the brands as we start growing them.
Sure, thanks. That's very useful. That's all from my side. Thank you.
Thanks, Anish.
Thank you. Next question is from the line of Vivek M. from Jefferies. Please go ahead.
Hi, Sanjeev. Hi, Ritesh.
Hi, Vivek.
2 or 3 points on royalty bit again, and actually these are essentially, the investor feedback that I have received. So, one view is this 10 percentage point margin increase or the doubling of revenues or let's say negative working capital. Wouldn't a lot of that would be, more of an India factor, more of, what you have achieved as Hindustan Unilever, even from a talent standpoint, while I hear you about, the talent management part that you mentioned, but India still has been, or Hindustan Unilever has still been, an important contributor to the talent pool. So how do you think about, how do you balance this equation between Unilever versus Hindustan Unilever in several ways?
Yeah. We have a very symbiotic relationship with Unilever. There are areas where, our pool of talent, we send them outside to Unilever group companies. We train them in the bigger part of Unilever in different geographies, and then we get them back. There are people sitting on this table right now, whether it is my investor relation head or whether it is my learned CFO, they have gone through the same drill. So that is something which will continue. But where Vivek, Unilever comes and helps us, what the chart that we were portraying earlier on, say, R&D. If you look at R&D, we are today trying to operate on 3 axes, where we meet the consumer needs, where we have products which are superior, and they are sustainable. Now, whether it is replacing fossil fuel-based derivatives in laundry through carbon rainbow, or getting into biosurfactants, or in, say, skincare, getting into microbiome, or getting into skinification, or getting into neurosignaling. Now, these are things where we have big global labs, where they have access to the whole ecosystem, and that HUL can access thanks to the relationship which we have with Unilever. The other bit is, Ritesh talked about procurement, for instance. Now, when you procure 20 billion euro worth of raw materials and packaging materials, you get certain big benefit of scale. You get benefit of relationships that have been built over the years across the world, and we get access to that. So there are very clear benefits which HUL gets out of Unilever, and the way I would urge all of you to look at it, it is like any other expense. Say tomorrow, if I were to increase the salaries of my people, then obviously the question will be, is the benefits that we get out of the talents that we deploy. Similarly, when we spend money on BMI or on royalty, are we getting the value for the spend? And I can confidently tell you that yes, it may not be apparent to naked eyes, but there are very clear benefits to HUL and the value that we get out of payment of this fee.
Got it, Sanjeev. Sanjeev, I'll tell you the worry that a lot of, and in fact, I have spoken to your holders as well on this issue. The worry is that can it go the Indonesia way? Because as margins are moving up, there is a 5-year visibility. And I think India still is half of where, or less than half of where Indonesian margins are. So the feeling is, a bit that, because you are now earning more, So the propensity to pay for that should go up sheerly because you are earning more, and otherwise, this higher royalty number could have been there from 2013. But that's the view, Sanjeev, and that's where the concern is quite frankly.
I'm glad, Vivek, you have raised this issue. Now let me try to dispel it. First is, if you were to do a comparative benchmarking, and this is something which Ritesh alluded to, we are better off than most of our peer group. Yeah? So it is not that just because there are benchmarks, we have tried to pay that kind of royalty. No. We have gone through a very detailed process. We have looked at it from a lens that are we getting value or not, and we have a fabulous people on a board as independent directors, and who go through that rigor to ensure that we are getting as a company the value for what we have contracted for. Yeah, and only after that process do we agree to it. Now, I would urge you to please tell your investors that not to worry about it. I don't want to talk about Indonesia. Yeah, Indonesia is still a great company, but we have to look at it from our context in India. We have had a very successful track record, and we are clearly amongst the top 3 priority countries for Unilever. And if you look at any of the strategies of Unilever for any of the business group, India would be right on top when it comes to priority. That means we get access to the best technology, we get access to the best of innovations, we get huge talent and resources deployed to meet the needs of the Indian business. So I would say that, guys, don't worry about it. Yeah, this is a business which is on absolutely sound footing, and a long-term strategy is very clear that we will have double-digit EPS, and just like the other expenses, we take it in our stride. Similarly, we will take this in our stride because it gives us value, and we will ensure that we keep delivering on a strategy.
Thanks, Sanjeev, for taking pains to explain this part. One more bit, if you can just clarify, because that's again come from two shareholders in Hindustan Unilever, which is, when you have had considered this proposal, the independent directors and governance side, nobody has any concern. But the view also is that should you not have gone to minority shareholder, taken a majority of minority approval as purely as a good practice, as a good governance?
Right now, we have taken just the board approval. And whatever is required as per law, we will go through that process. We always maintain the highest standards of governance. We comply with the law of the land. Whatever is required, we will do that.
And Vivek, as you mentioned, this is subject to necessary approvals that we require to complete a transaction. The first process of any such transaction always is board approval. You can't get into any further regulatory approvals unless the board has approved, and which is why that's always the first step. And of course, we'll end up doing, as Sanjeev mentioned, whatever other approvals we require under SEBI LODR or for that matter Companies Act, we will get those approvals as well. And given the value that is there, to Sanjeev's point, in this for all shareholders, we are even confident that we should be able to secure those approvals as well.
Yeah, what we are alluding to, Vivek, that forget the minority and majority first. I think the most important way, and even we as management do, we first look at the interest of the company and all the shareholders. That's what we are being paid to do. And that's what we will keep doing it.
I think that will be reassuring. Just on this bit, Ritesh, are you suggesting majority of minority approval will be needed in this case?
See, if you look at the SEBI LODR and the requirement, there are two different requirements. There's a requirement for royalty and there's a requirement for all other transactions. And as appropriately, a related party approval, whenever you do, you will always end up having the related party not part of the conversation. So as I mentioned, whatever we need to do as a next step, the first step was board approval, and which is what we have taken today. And we will do appropriately what was required in the SEBI LODR and for that matter Companies Act. And that's the next logical step for us. Yeah.
Got it. And last question for you, if I may, Ritesh, which is basically, let's say, until whenever this proposal was put up, to the board, until then you were running with some assumptions from a few years standpoint. How does this incremental, let's say, 80 basis points change those? Will they, like Sanjeev mentioned briefly, do you envisage, offsetting it and therefore still, reaching the goal? How will this play out purely from a P&L standpoint?
The overall, Vivek, as you remember, when in the Capital Markets Day, we spoke about our long-term financial growth model, and we had articulated our long-term financial growth model. We are aiming to deliver double-digit EPS growth for medium and long term. And at the end of the day, there are various costs. Costs like this are always part of the assumptions before you make a long-term plan. And so in spite of this cost of it, but any other cost, we are committed to deliver double-digit EPS growth. And as we called out as part of that financial growth model, unlike the past decade, where our strong EPS growth has been driven by top line and substantial margin improvement, the next decade EPS growth will be driven more from top line growth and with a modest margin improvement. And that modest margin improvement will come because of two reasons, as I called out. A, because the mix of the portfolios keeps improving, the way we drive market development for driving premiumization, and second, the leverage that the P&L gets because of the scale of growth that we have in the business. So that objective of driving double-digit EPS growth does not change.
Got it, Ritesh. Got it, Sanjeev. Thank you. Wish you all the best, and look forward to double-digit growth numbers from you year after year.
Thank you. Thank you.
Thank you. The next question is from the line of Arnab Mitra from Goldman Sachs. Please go ahead.
Yeah, hi, Sanjeev and Ritesh. Thanks for taking the question. I just wanted to understand your commentary on rural a little better. Clearly, you are sounding more optimistic now than, let's say, 3-4 months back. Other than the Nielsen data, which is showing some improvement, are there other data points or your own sales analysis that makes you a little more confident that we possibly are going to see a modest improvement from here on?
When times are tough, you look at green shoots, right? And there was a period of time when we used to look at Nielsen data. We used to very clearly see that even the value growth in rural has turned negative. That was in the mid-year. And a big company like ours, growing headline growth in mid-teens, would not have happened if we were not growing value in rural. So the good bit is that despite this high inflation, people in rural area, when it comes to real rupee paise spending, they have been spending more than last year. Yeah, and certainly on our brands. And even when I look at it today now, rural, in the last 5 months, we have seen value growth. And this value growth in the December quarter has been higher than the September quarter and the MAT number. So these are the green shoots. Yeah. But like last time, if you remember, I had alluded to that there are a couple of things we will have to observe very closely. One is that when the government stops the money on the free food grains, and what then happens to Manrega budget? Yeah, whether the government keeps a leash on Manrega, or do they spend more on Manrega, or there is more demand on Manrega? That would be one indicator. And the other indicator would be, of course, how the market shapes us in our category, which would then be linked to what happens to harvest, what happens to the ingredients which go into, what happens to the net realization of farmers, and what happens to the rural wage growth. All those factors will come in. So we are not jumping to conclusion that everything is hunky-dory. What we are just alluding to, from a real bad period in June, July, we have definitely seen improvement.
Thanks, Sanjeev. Just one follow-up on that. One change I noticed was that till last quarter, you were highlighting low end of beauty, essentially brands like Glow & Lovely facing a challenge. This quarter, your non-winter skincare seems to have grown much better. Are you seeing that pressure now behind in terms of the mass personal care kind of categories?
Our total beauty and personal care, as you would have seen, has grown in double digits. And even when I look at this quarter, our GAL growth has been reasonably decent. In fact, it has been in double digit. Yeah. And but yes, the winter was for instance, Vaseline is a big brand which sells in winter, where the sales definitely shoots up. That was impacted because the winter was very slow in coming in December.
Understood. And my last question was on gross margins. So your gross margins are now 47, and if I look at the pre-period of this very high inflation, it was 52 to 54. You're still very behind that number. So from here on, assuming that crude and other commodities don't go down further, do you take an approach of continuously passing pricing over a longer period of time to get back that margin? Or is margin improvement from here on contingent on commodity costs actually falling more from where it is currently?
See, margin improvement, assume for the time being that the prices stabilize at this level, right? Then the margin improvement will come through premiumization of portfolio, the mix change, and the margin improvement will come out of leveraging the scale. When it comes to pricing, we will always be conscious about the price-value equation and competitive pricing. We will never outprice ourselves.
Sure. And just one add-on to that, there was this news that you had further taken price increases in the month of January. Is that accurate? And have you taken further price increases in this quarter as we speak?
Yeah. So, on pricing, in December quarter, let me call out two categories, which is first is fabric wash, home care, and second is HFD. These are the categories where we have seen sequential increase in commodity cost. And we called out some of those commodities, be it milk, be it barley, be it soda ash, and of course the impact of rupee depreciation as the dollar keeps strengthening. And because of that, in those categories, we have taken sequential price increase. On the other way around, we called out two categories, be it tea or soap. Those are the places where we also then reduced our prices, passing on the benefit to some extent on commodity coming down. But if I just go back to the question conversation that Sanjeev mentioned earlier, the price versus cost. If I look at last quarter, we had 22% net material inflation and we had 12% pricing. So net 10% price versus cost gap. That in December quarter has come down where the headline inflation, net material inflation is 18% and our pricing has been 11 and hence a net price versus cost deficit of 7. So the job that we will have to do, as Sanjeev articulated earlier, is to keep working through this price versus cost gap through innovation, through mix, through scale leverage, and then work through gross margin improvement in quarters ahead.
And we must understand that when you look at the total company results, they are the weighted average results of the company. Now, within that, there could be categories where the commodities could have gone up, where we might have taken price increase, and there could be commodities where the commodity price has gone down, where we would have taken the price down. Yeah, but what you reflect on total company, of course, is the weighted average.
And to a specific question on the January newspaper article, I'm assuming you're referring that we had clarified it was factually incorrect.
Okay, thanks so much, Sanjeev and Ritesh, for all the best.
Thank you.
Thank you. The next question is on the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity. Question again on pricing. You mentioned that sales will be price-led. Is this only in the near term, or would you say that this could apply to FY24 as well? How should we look at the equation in FY24, assuming raw material price stabilizes as price hike becomes a part of the base and some price cut or grammage which you're taking in categories like soap start kicking in?
Now, first, let me explain that ideally, we would want volume-led profitable growth. That's what we would want to deliver. Yeah. But when you have this kind of inflation, then obviously we will have to pass on the cost to the consumers to protect the business model, but we do it in a manner that a consumer franchise remains protected. Now look at it, Kunal, that even during this December quarter, when the total volume, as per Nielsen, has shrunk for the market by 4%, we have grown our volumes by 5%. So that is significantly outpacing the market. So we never take our eyes off volumes. Yeah, for us, the underlying volume growth will always remain a key performance indicator. But we have to live in a world which we have to confront the reality. And the reality is that if the prices go up such extent, the consumers thankfully are still spending more money, but they would titrate the volume, which is completely understandable. And we are gaining both volume and value shares. So look at it from that lens, that we have significantly strengthened our business in the last 2 years. Gaining volume shares, gaining value shares, and protecting our margins to the extent possible.
Just to get this right, so as the pricing contribution moderates from here, do you see volumes offsetting that? How do we see the sales growth from here?
See, the volume will, of course, be driven by, I believe, that if one is moderation of inflation, the other is the inflation which had come in recedes. Leaving aside palm oil, we have not seen the receding of inflation. Yeah, just to give you a very simple example, if we look at crude oil versus same quarter 21, the price growth has been 10%. So it would look very nice. Yeah, it's a moderate price increase. But when you look at versus 2020, it's 100% increase. So in simple average, it's 90 and 10. Yeah. So it is not that like palm oil, where versus December quarter 20, the price increase is just 5%. That means the prices which had gone up, it's not that they are now growing at a lower rate, they have come back. And that's when we pass back to the consumers. And that is when we will start seeing the volume growth come back. That has still not happened, leaving aside a few commodities.
Sure, that's clear. Second and last question, what are the trends which you are seeing in the D2C space? You've seen acquisitions by FMCG companies of these companies. Are you seeing reduced aggression from these new players and as their funding is drying up? And also if you can talk about any trends which you are seeing in B2B e-commerce, any reduction in contribution from these days?
It is very apparent that when the modern trade stores were closed during COVID, or they were not operational in the full capacity, that was a time when a lot of consumers had shifted to e-commerce. And of course, in a country like India, is shopping in modern trade goes beyond shopping, right? It's an outing for the family. People still love to go and do shopping. It is touch and feel. So as modern trade has opened up and the growth rates in modern trade have picked up, it has impacted the D2C space, certainly. But D2C, for the sheer benefit and convenience that it offers, it is going to be a secular growth story. Albeit, it's still a small channel relative to, say, the general trade. Yeah, but the growth rates will remain faster. And it's also a reality that the time of easy money has gone away. And investors, I would believe, would start now focusing not just on the headline growth, but also on the business fundamentals. And in the long term, there is no substitute for business fundamentals.
Understood. That's it from my side. Thank you very much, sir.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Broking. Please go ahead.
Hi, good evening, Ritesh and Sanjeev. Thanks for the opportunity and my hearty congratulations for the stupendous growth in the quarter. Just one read through while in my field trips, what I found that there is an incremental consumer shifting from detergent bars to powder. Now, to what extent this phenomena is there? Because to my understanding, Central India and the Northern India were behind the growth in the powders. So is that growth is now primarily driven the upper half of India, and there is some more growth is latent, which is also going to come in the subsequent quarter?
If we look at, it's not that the bars have disappeared. Yeah, bars is still a pretty significant part of the market. And the other bit is mass markets. The mass market segment is still a very large component. So our strategy has been to move the bars to solution wash. Our strategy has been to upgrade consumers from mass powders to higher order benefits, and from powders to specialists, is like liquids, like matics, and that is the strategy that will continue into the future. And I can assure you that despite fabric cleaning being a universally penetrated category, the headroom to grow is massive, and we are over-indexed as you go up the pyramid in terms of market shares.
Understood. Very good. The other question.
This is a good question, and for all my friends on the call, I would just let you all reflect on that the work that we did on laundry, which I was, I think, explaining to Vivek or Abneesh, or what we did on tea. We have to do the work consistently for a few years before you start seeing the benefit in the results. And this consistent strategy, executed with precision, and knowing both the science and art of market development, that's what gives you joy. And the similar thing we have done in hair, for instance.
I got that, Sanjeev. I completely echo that, having spent time on the field. The second related question on this is that the 32% growth what we have gathered in this quarter, is it suffice to say that 50% is coming from the price and 50% is volume, or 2/3 is price and 1/3 is volume?
No, about 40% say volume.
Okay, thank you. And my last question, if I draw the parallel, you did mention in between that, or Ritesh did mention that we are doing a lot of work around the HFD on the activation. And we have taken almost 5-7 years to get the benefits in the detergent and home care business. Does that mean that the similar time it will take in HFD beginning?
No. It is not that. Our laundry results have been giving us results for the last 5-6 years. It is not that now we have reached that point where we are outpacing the competitors by a mile. That's where we have reached. So I'm not saying that HFD we are going to wait for 7-8 years to see the results. I believe the results will come in much earlier.
So actually, I'm looking for a qualitative comment of when actually we see growth which is higher than 10%.
Let me give you like this. That had the inflation not been there, we would have got the results by now. Yeah, but with the increase in prices of barley by 120%, skim milk powder by 50% over the last 2 years, that's made a significant impact. Otherwise, we would have got it much earlier. So if say the commodity prices, if there is a certain stimulus which leads to commodity prices deflating, then we'll start seeing a much higher growth in HFD come in much earlier.
I agree, Sanjeev, your point, but just to dwell on the amount of sampling we have done, 1 million plus sampling, and the penetration and distribution what we have done. I mean, somewhere
1 million se zyada kiya humne. 1 million to bahut kam hai.
Sir, that's what I'm saying. That where is the conversion? Is still.
Today the conversion is happening in terms of shares, etc. The conversion is happening when we are getting increase in the penetration, where we are bringing more consumers into the fold. Yeah, but then what happens at the middle class level, people who are using the bigger pack jars, they start to reducing the consumption to manage the budgets. Yeah, as that eases, this will go back. And our job also is to build much increased relevance for the category. And our plus range is doing exceedingly well.
Sure. Wonderful. Thank you, and all the best to you and the team.
Thank you.
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, sir. In one of the earlier questions, you mentioned that basically apart from palm oil, you have not seen commodity costs correct meaningfully. Now, my question is, supposing if they just stabilize at where they are rather than correcting, in that scenario, how do you see the volume growth and the overall top line growth and margins panning out? Because also in addition to this, there was one more question on the margins, where you mentioned that from now on, the margin expansion will come only if the input cost goes down or due to normal premiumization, cost efficiencies, etc. But I think 1 or 2 quarters earlier, you had mentioned that we would reach 25%, 25.2, which was there before the inflationary cycle started. We would reach there pretty soon, and after that, we would have modest margin expansion on back of premiumization, etc. So just to summarize my question, if the input cost remains where they are, how do you see the effect on volume, top line and margin?
I get you, Percy. Percy, if you look at the story of the last 9-10 years, when we have improved the margin by 1,000 bits, it is not by moving away from the strategic price points. Yeah, we improve the margins is one by getting the benefit of scale. Second, importantly, is premiumization. We are not significantly over-indexed to the market in terms of premiumization. The third is market development, getting into new segments which are inherently having a higher margin. Yeah. And wherever there was an opportunity where we took modest price increases, we kept doing that. So that was the rhythm. Now, your question is, if the commodity price, this becomes a new normal, for instance. Yeah, so this becomes a zero-based from here onwards. Then we will have to play a similar game, drive our saving agenda harder, which we have been doing, and keep doing that. And if more cost increase doesn't come in, then the saving agenda will translate into margin improvement. Similarly, if more inflation doesn't come in, our mix change will translate into margin improvement. And that's how the way we played the game in the last few years, similarly we'll play going into the future. And if we are at 23.6, and also, Percy, we will not shy away from investing behind our brands. We invest. Our share of voice to share of market is anywhere in the vicinity of 120 to 130. We're not going to shy away from that, and that's what we will maintain, because we always play the game for the long term. And getting it from 23.26, if we can come from 14, 15 to 23.6 or 25, 23.6 to 25 is not a long journey, I can assure you.
Understood, sir. And also on volumes, you are currently clocking around 5%. Yeah. So any acceleration from here, is it contingent on commodity costs actually going down from here, or they can accelerate in a scenario where commodity costs are stable at this level as well?
Because this has also got to do with macroeconomics, right? If, for instance, India has another year of 6-7% growth, and even if the inflation is at a modest 4-5%, you would be talking about a nominal growth which would be in the vicinity of 11-12%. And if that happens and it is dispersed in a sensible manner across the population strata, then I see no reason why they will not start consuming more.
Understood. But I would be right in assuming that in FY24, if we are to target close to a double-digit top-line growth, then we would have to do at least a high single-digit volume growth to reach there. Would that sort of construct in my mind be reasonable?
Percy, you're not wrong, because historically we have delivered anywhere between 65 to 70% of our growth through volume growth.
Understood. So my second question is, sorry, couldn't hear that.
I said that's under a normative environment.
Understood. My second question is on skincare, which was a category which was affected by the COVID-related disruption as well as the pressure on incomes, inflation, etc. Now in skincare, apart from the adverse seasonality, your portfolio has grown in double digits. So would you say that basically whatever issues were there from a macroeconomic standpoint in this category, they are resolved and the recovery is sort of done and dusted, or do you see some, we are only partially through the recovery in your view?
Because, Percy, there has been price increase also in skincare. Maybe not to the same extent as skin cleansing or personal wash and laundry, but still there has been a good price growth in skincare. So the real test will be, because it is relatively discretionary, when the consumers have more disposable income, I would believe that is when we will feel far more confident about skincare. Either the inflation remains where it is, doesn't go up, the commodity prices don't go up, or they start deflating while the GDP keeps growing. That would be then we'll certainly see discretionary items like skincare getting a much bigger fillip.
Right. And my last question is on this free food scheme, which the government has recently sort of rejigged. They have discontinued some part and they have sort of made the other part free, etc. But there is still a net sort of hit to the inflows into the hands of the poor people on account of this scheme. What is your view? Is this like a material macroeconomic event for FMCG, or it's something which we should not dwell on too closely, or we should not sort of focus too much energies on?
No. The way I would look at it is that government had put in big budgets under two schemes. One was when they were giving certain 5 kgs or something free ration. The other was subsidized ration at 2 rupees a kg and all. So what they are doing is they have pulled out the free that they were giving, but the subsidized one, they will now give it free. So earlier there were 2 benefits coming in, but there would be. I think, as first looking at it from a national perspective, relief of the stressed is one of the big core jobs of the government. And one of the reasons why the headline growth in rural has remained during these tough times, during the COVID period and during the post-COVID high inflation period, has been the support that the government provided to the rural poor. And getting into the election year, I think every government will be cognizant that you need to look after your poor who are stressed.
Right. That's all from me, Sanjeev. Thanks and all the best.
Thank you.
Thank you. I now hand the conference back to Mr. A. Ravishankar to proceed with the text questions received by the webcast participants. Over to you, sir.
Thank you. We'll start with questions from Richard. 2 questions. The first is on rural. His question reads, from what we hear from most companies, this whole narrative of rural recovery seems to be premised on government doing a lot more for the rural folks, base effect apart. In the event the government chooses not to be populist in the run-up to the next election, what actions can companies take to drive a recovery? Example, what levers are available at HUL's disposal to drive the recovery, assuming no help from government?
Thanks, Richard. On rural, as we called out, there are, of course, more than one variable. There will be, of course, variables that government will lean in terms of support to rural economy. And for a minute, if I just keep that aside, since already a lot of work has happened in terms of support, If I just look at our own internal variables within FMCG, the point that you mentioned that the biggest hurt that rural has got is on inflation. And with inflation, as we spoke, peaking out in September quarter, and we have seen moderation in December quarter. And if that trend continues, that will surely augur well in terms of the bite the inflation has on overall disposable income and the spend capacity that consumers have in rural area. We also seen pretty good encouraging data on farm income. That also augurs well. We've seen farm inflation and hence farm margin. That also augurs well. We've seen the sowing which has happened for winter crop. Hopefully that will also give good amount of boost. So there are more than one factor which is also in this point in time is favoring the amount of work which is happening in rural area. At this stage, you saw our commentary. We do see the rural slowdown is bottoming out. And in our mind over the next few months, 3-4 months, we'll have to see as to from once it has bottomed out where the trajectory goes from here as each of these variables that I mentioned about, they start to pan out. In the meantime, the job that we have to do on market development, we continue to do that job. And that is a longer term story, as we mentioned about value creation for FMCG overall. With India having spent $46 per capita consumption, rural within that, as we had spoken about, is more like $25-30. So there's a massive amount of job to be done in terms of developing market in rural area. So the long-term trend of value creation in rural area by driving consumption penetration, that will continue. So those levers, apart from what I mentioned about the macro context lever which are changing now, should help us to keep driving sales. But this is something in the next few months' time we'll see how it pans out.
All right. The second question is on the royalty arrangement. In the last announcement on royalty change in 2013, the terminal rate was to have gone up to 3.15, but that rate is still 2.65. What were the reasons that the rate didn't go all the way up to 3.15 as agreed last time?
Yeah. So what has happened also along the way in last 1 decade, when we had put up the royalty contract a decade ago and we had seen the destination to reach to 3.15. And but the portfolio has evolved over last 1 decade. And the substantial impact, Richard, which has come is through acquisition of Horlicks, which we bought the business from GSK, Horlicks and Boost. And these brands have been acquired by Hindustan Unilever, and the trademark is owned by Hindustan Unilever, so they don't attract the charge of royalty and trademark and for that matter technology. Similar is the case with Indulekha, similar is the case with VWash. So there are this portfolio that we acquired and we have grown, and this portfolio does not attract those costs. And hence the weighted average cost as it has panned out is lower compared to what was envisioned when we done the contract a decade ago.
One other question on royalty, and I think we can then call it a day. What has changed for higher royalty? There's a question from Manoj.
Manoj, we spoke a little bit at length as to what has changed for royalty. As I mentioned, the earlier contract was done a decade ago. And as the contract has expired and we have to sit and renegotiate contract with Unilever, and as they approached us to revisit the current contract, when you end up entering in the contract, you have to then see what are the latest set of rates at which these contracts are done at arm's length in the industry. And which is why independent benchmarking has been a very big input to what we end up agreeing as a rate going forward. And I had captured when I spoke earlier that the board commissioned independent study by Big Four, and then the rates that we have now agreed and the board has approved the cumulative impact of that, as I mentioned, for royalty, both components of trademark and technology put together is 1.95, and central services that you get from Unilever is 1.5. These rates, when benchmarked, they are extremely competitive. And as Sanjeev called out earlier, it's a public data in all the annual reports. The rates after increase also will be at the lower end when we compare with our peers. So it's an extremely competitive set of rates. And more importantly, as the point we mentioned earlier, there is a cost which gets incurred. But equally, there are benefits that we receive. And over the last 1 decade, the kind of benefits that we have received from Unilever and that we continue to get, be it the strong brands, be it for that matter capability, and some examples I quoted of what benefit we're getting and how impact those are creating to our business, be it digital marketing, the example I was quoting on net revenue management, what Sanjeev mentioned about procurement global scale. When we add what we buy to 20 billion euro purchase that Unilever does globally, That's a scale advantage we get when we procure materials. And this expertise of commodity risk management, market expertise of understanding what's happening with commodity, those are the benefits we get from Unilever. Or for that matter, learning content, ESG, on sustainability, massive amount of work happens in Unilever, and we have leveraged that work as we have driven our sustainability agenda in the country. Today, we are rated one of the top in the country on ESG metrics, and a lot of learning and inputs have come from the learnings that we have got globally in the space of ESG and the way we drive it. So there are those associated benefits. So, and ultimately, as I mentioned earlier, where does the cost sit? Royalty, all the three components, trademark, technology, and central services, they all sit in the line of cost, overhead cost, and other lines of the P&L outside material cost. And if you see this line, even for the earlier contract, which is going to conclude by end of January, and the results up to December quarter, over a period of time, our percentage cost to turnover has kept reducing, and including the cost of royalty of 2.65 that we pay today, the total amount of other expenses that we have in our P&L, they are at benchmark. They are lowest, one of the lowest in the industry in the country today. So that's the level of cost efficiency we've been also able to deliver because of those capabilities. So that's what ultimately justifies as to where we are in terms of the rates. And these are the costs and investments, in our view, which are genuinely required for us to keep doing the business and performing the way we have performed over the last decade. And we shall do the same over the next decades to come as well.
Thank you, Ritesh. With that, we now come to the end of this session. If there are any unanswered questions, please do reach out to any of us at Investor Relations. Before we end, let me again remind you that the playback of this event is available on the Investor Relations website from a short while from now. Thank you and best wishes. Good night.
Thank you, everyone. Thanks for joining.
Thank you very much. Ladies and gentlemen, on behalf of Hindustan Unilever Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.